Okay.
Oh, hello. Are we live?
Yeah, we are live.
Yes, I can confirm that we are live. Welcome back, everyone. We are back, and now it's a monthly show, no longer a weekly show. But we are. I hope we weren't away for too long. Ken?
1 week, 2 weeks, 2 weeks.
2 weeks we were away, but anyway.
Raya break and then Liberation Day practically.
Yes,
right?
we weren't around for Liberation Day.
But here we are.
And I think we're back right on time because last week and the week before we were seeing a lot of volatility in the market. In fact, the S&P had some of its worst days in recent history.
Yeah.
So it's because of all the tariff talk, right?
Yeah.
When we see over the 4 days since the full announcement of tariffs, the S&P fell around 12%. And then on Wednesday, when the tariffs were taken back, were paused for 90 days, we saw that the S&P jumped up in 1 day 9.5%. So one day the US is tariffing the world, and then the next day there's a 90-day pause. How do investors, navigate this kind of thing? That's what we want to answer here today. And I also want to ask, why are they tariffing the penguins, Ken?
Because they deserve it.
the penguins.
To make America great again, you need to tariff the penguins.
Tariff the penguins.
Yeah.
So what can everyone do? What can we all do about this as investors? So welcome everyone to In Your Best Interest, Malaysia. If you're new here, my name is Imran. I'm the financial writer here.
And I'm Ken, the country manager of Stashaway Malaysia.
Yes, and as usual, before we get into the show, I just want to have a little bit of a disclaimer where this is not financial advice. Yeah, please don't take this as financial advice. We're just talking about what's happening in the markets. And we can do that by going to our first segment. So let me just set up a little bit of context for those out there, for everyone out there. It's been quite a roller coaster. So to sum it up, you can imagine that President Trump, his administration wants to balance the trade deficits for the US. And the trade deficits is simply the gap between what countries sell to the US and what they buy from the US, right? So if the countries are selling more to the US than buying, then that's a deficit.
To the US.
Yes, to the US. So the US administration, current administration, sees that as something to be fixed. And also, if they start to tax all these imports, they want to create a scenario where these companies want to bring back manufacturing to the US, right? Build those factories in the US, and at the same time, get all the tax revenue, right, from all these import taxes to fund future tax cuts. So that's the overall plan. That's the overall policy.
If it was presented to the public and to markets, how you presented it, we would not be in this mess. It was just kind of presented in a very ad hoc way with a big placard, and then the world went into descended into madness.
It's a very nice cardboard board, though.
Yeah.
So that's the policy, but what has been the effects on the market? I think that's what we want to know, right, Ken?
Okay, so because it was such a dramatic week, or at least trading sessions, right? 5 trading sessions. Imran mentioned just now it was minus 12% in 4 days. So I went back to year 2000, so over 20 years, 25 years, to see where this week ranked in terms of how bad it has been. So if you take, let's say, a trading week, which is 5 days, this 12% drop, or in just 4 days, would equal the 10th worst week going back all the way to 2000.
To 2000.
Yeah, year 2000, since the turn of the millennium, right? So this is the 10th worst week, right? Equivalent to the 10th worst week. And if we looked at the first day that the market reacted, the market fell more than 4%. So I looked all the way back to 2000 and see how many days actually declined more than 4%. And actually only 43 days out of like over 6,000 trading days, only 0.7% of the time have you experienced a more than 4% drop.
Wow.
So this is a
0.7.
Yeah, so this is like a less than 1% occurrence.
Okay.
Obviously, the next day it fell 5%, which is an even rarer occurrence, right? Because there's less data points. But my point remains that this is a really historically bad period or stretch of time no matter how you look at it. But as we will review later on,
Yes.
it could be also some of the best days to enter the market.
It could be.
And you know, after a few trading sessions from hell, the market rebounded 9.5% after he paused
Yes.
the tariffs,
That's
right?
when he paused it.
And obviously, this caused huge whiplash to investors who are like, okay, the world, the there's a new world order. Okay, the new world order is on pause for 90 days. We don't know what to think about it. But all these rare moments can contribute into good entry points for investors,
Yes,
actually.
as we'll get into, like,
Yep.
what can you actually do about it, right?
Yep.
And also, I just wanted to add that for those not following so closely, so there is currently a 90-day pause, but
Yep.
there is still a 10% blanket tariff. And the most recent news is
I forgot to mention, when the markets rebounded 9.5%, it was actually the third best day
in history.
since 2000
Oh, since those, okay.
in terms of a single daily increase.
Wow.
So it's the third best ever. I mean, since as far as we can remember, right? 2000.
That's a great point, because
Yeah.
what you're saying is it was the 10th worst week, but then it was followed by the third best day.
Yeah, since more than 25 years.
Okay.
Yeah.
So many bests and worsts.
Yeah, when you have all these like really record-breaking moments,
Yeah.
that's really when you should take a pause and go, is this an opportunity here? Is there something I can do about this?
Yes. So let's get into it, because I have some very beautiful charts here
Ah, you came prepared.
by our designers.
He did homework. In the 1 month we were away,
Look,
Imran got me more time.
time to prepare. You know, I got time to prepare.
Okay, can see or not? Okay, very hard to see, but
Yeah, let's see if you guys can see this. I'm checking the stream.
if you zoom in close enough.
You cannot.
Oh
see
yeah,
it.
that's not bad. If you squint,
Okay, maybe if you are on a 4K monitor, maybe you can see.
you're caught in 4K.
But it's okay, I'll explain it, because what I'm trying to show you here is that there have been many crises, right, throughout the S&P 500's history, and we're using the S&P 500 because it's a reference to the US market.
Yeah.
So, for example, you have Black Monday on the, was in 1987. On the 19th of October in 1987, the S&P's index level, so what the S&P 500 was reading, was 225. And then, just 5 years later, on 19th October 1992, the index of the S&P 500 is 415. And if you include your dividends, you include stock buybacks, everything that contributes to returns, your 5-year total returns for just staying invested at the point of Black Monday would be 119%. 119%.
So you more than double in
More
5
than
years, you know, since
your
Black Monday.
investment. And one more example, just to drive home the point. The closest one, COVID-19. So back then, on 12 March 2020, the S&P 500 was at 2,481, and then 5 years later, it was at 5,599. 5 years later would be 12 March 2025. So, and your 5-year total returns would be 143.7%.
Again, doubling your money
Yeah. So, but I mean,
in 5 years.
it's one thing to talk about history, right? But history is not a guarantee of future performance. So, what can you actually do about all this volatility, Ken?
Yeah,
You want to get into it? I have
I
more graphs
will.
to help you here.
I will. Yeah, I was just thinking about the long-term returns of the S&P.
Yes.
And since doing the show, you know, we've obviously referenced it a lot. We've given out awards for how well the S&P
Yeah.
has done
Wow,
and all
that
that.
was the best.
We had really good years in 2023, 2024, and the 10-year returns for the S&P is around 12%, right? Average returns. So some people say, why don't I just invest in the S&P and kind of forget the rest? You know, who cares about diversification? And kind of to enjoy the 12%, you need to endure this kind of volatility.
Yes.
And as we'll talk about later as well, if you cannot stomach this volatility, you need to diversify, right? So 3 things you should look at doing, or at least seriously consider doing. The first thing, surprise, surprise, stay invested, right?
There we go. This one will help you.
Staying invested it sounds very, you know, kind of like repetitive at this point, because that's what we keep doing. We say stay invested, look at the long term. But staying invested is especially important now, because selling when the market has had the kind of 10th worst week in the history, the last 25 years, is panic selling, the very definition of panic selling. And in the markets they call it capitulation, meaning you kind of react. It's the strongest reaction you could express when it comes to markets. Meaning you just give up. You're like in fear, no reason. You don't really need the money now, but you just panicking and you just capitulate. You're out, right? You panic, sell. So that's why staying invested is important. But also, I think this chart shows that some of the best performing days, 1 day performance, are literally like within a week of the worst performing days. So in Stashaway, we've been around for quite a while, more than 5 years, and we keep saying these things. And now we've experienced it because we've just been through such a bad stretch. And then suddenly 9.5%.
Yeah, so the funny thing is, it literally just happened. It's the 9.5% jump.
Yeah, exactly.
So if you can see here, again, sorry if you can't really see the graph, but you can see the green spikes. Those are the best days. And this is a daily chart, yeah?
Yeah.
So then the
this is daily.
This is daily. So
Oh,
then
this is 2008. This is I guess an event analysis of GFC.
Yeah, so we were looking at GFC.
The thing to note here, green line, close to red line.
It's like super, like just days apart, right?
Green bar, close to red bar.
So that's our point, right? You want to stay invested.
The second thing is dollar cost averaging. So again, I know it's repetitive, but so is dollar cost averaging. Hey, see what I did?
Oh my God, Ken, you know what's so funny? You did the same joke that when we talk about dollar cost averaging
Really?
as well, repetitive.
Okay, I don't remember. I thought there was a Ken original. I thought I was like, new material.
You did it as well.
Okay, really?
Yeah.
Okay.
I can find the footage.
Okay, we'll do a flashback to the same time I did the dad joke. Okay, I've got 2 kids, let me do my dad jokes. So DCA, very important, not just because in a normal month, evergreen situation, you just say dollar cost average because you earn money and then you put it in and it's an entry point. If you had DCA at the moment we fell 12%, you would effectively have bought the dip. I have a problem with the overall statement buying the dip, but I think if your timed deposit happened to be in that week, you would have picked up some of the best value in terms of US equities in recent memory, right? So dollar cost averaging, again, super important. The last one here is diversification.
And yes, so the last point is diversification, but I thought it's probably better if we cover diversification in our
DCA.
This one is showing DCA. So we'll cover diversification, our final point, in the very next segment because it's very relevant. Because the next segment we'll be sharing our portfolio's returns.
I think that's why we are here.
That's why we are here as well.
That's why they are here to understand. Hey, your portfolio go down how much in the last 2 weeks?
Yes, so we'll be answering that.
Yeah,
we'll be answering that. Just let me see here. Give me a second. Yes. Okay. So now we go on to our next segment. Let's talk about some numbers, and we'll be sharing.
Well, we take holiday 2 weeks. You're very rusty already.
I'm sorry. I'm so sorry. We cut this in post.
Okay.
So let's talk about our numbers in this segment. So what? Actually, sorry. Ken, you are supposed to deliver the numbers, no?
I've got some numbers.
Okay.
I'm waiting for you
do.
to cue me. Okay. So market context, right? So essentially, the S&P fell 10% from its peak in February, right? And the reason why our portfolios have outperformed all of our benchmarks in Q1, which doesn't include the 2 weeks since Liberation Day, but we'll come to that in a bit, is because of 2 main things. The first thing is gold. Gold has done very well. Gold is up 18% year to date, as opposed to US S&P, which is down 8% year to date.
It's
right?
down 10.1 year to date.
Yeah, 10.1.
Right now.
Okay.
Yeah,
Oh, not as of last week. Okay. Yeah. And global stocks have actually have gone up 5.1% in Q1, as opposed to US stocks, which was down 4.1% in Q1 as well. So that would signal a little bit of the flow of funds out of the US into global equities, because maybe investors are still they still have a risk-on point of view, and they are leaving the US for different markets. So this almost 10% performance gap shows you that diversification does pay off. And obviously, I think we will continue to see volatility. There will be times where the portfolio declines, our portfolios decline because of the market noise, but we will not react to any news flow or specific policy, but
I think that's very important.
But we will respond to economic data, which I will emphasize at a later point. I will talk about what our portfolios respond to and what it won't respond to.
Yeah, and I think what Ken just mentioned, so we are talking about general investing portfolios powered by Stashaway, to be very specific what we're talking about. And something interesting that is that even within these US assets, so the GI portfolios are invested in the US, even within the US market, we saw a bit of divergence between sectors. Right, so we actually do invest sector by sector. So for example, something more defensive like healthcare and consumer staples, because of those investments, it sort of helped to cushion the overall impact on the US market, right? And I think that's really what I wanted to emphasize as well, diversification, right? So that's diversification has been a very big part of our portfolio's performance in general. And also, I wanted to say that our full performance report will be out within the next few days. So if you wanted to
for Q1
2025, so if you wanted a deep dive into the numbers, keep an eye out on your mailbox, and you'll receive the full performance report.
Spoiler alert: we did well.
We did well.
Yeah. Spoiler alert: we did well.
We did well, considering the whole environment that we're in. Also, I wanted to clarify. Yep. So whatever Ken just said earlier, and what I was saying earlier was for Q1 2025. I think what people want to know as well, the past
impact on the last 2 weeks,
right? So most of the volatility has been happening in the past 2 weeks, starting in April. And let me tell you, just a few numbers. If you take the past 2 weeks into account, year to date, up to April 10th, the S&P is down 10.1%, as I said. And our most aggressive portfolio, just to use as an example, SRI 36%, is down 4.7%.
So less than half.
Less than half the decline. For comparison, meanwhile, something like our SRI 22%, which is a little bit more balanced, so you have a little bit more fixed income allocations, that has been down 0.3% year to date.
Oh.
So compared
really
to 10.1% down, 0.3% down. And our SRI 6.5%, the most conservative portfolio, is actually up.
See, this is 2%. This is the time when all those investors that have asked us, why don't I just invest in the S&P, right? This is the reason why. Diversification can really protect your downside.
Yes.
Or as opposed to being so concentrated in the S&P and therefore de facto tech as well. So when you get hit hard by things like DeepSeek, or you get hit hard by tariffs, the volatility is something you need to accept as a pure investor in S&P, even more so if you're a pure investor in NASDAQ. And that's why investing in a broadly diversified portfolio can actually maintain your sanity, that's one thing, but also maintain the value of your portfolio so that you don't lose the entire value of your portfolio in a very short period of time. And therefore you stay in the game, you stay invested, then you dollar cost average some more, then you're on firmer footing as you go forward. I think people just think that, I just invest in S&P and then it's so easy. This is the kind of stuff that they have to deal with in order to realize or deserve those returns that we talked about.
Yeah, I think it's also the broader topic of like what is your risk level, right? So, and how to accommodate for your risk level is what you invest in, right?
Yeah.
And your asset allocation as well. So
in the past 2 weeks, if you lost any sleep because of your Stashaway portfolio or because of your stocks that you bought on other platforms, that's a really good indicator of whether you can handle the risk or not. And then maybe it's time to review the current risk that you are in position. And consider diversifying further to reduce the risk overall.
And the purpose is you want to stay invested and to get those gains. Like that is the purpose.
Not panic selling,
Yeah.
right? I think anyone who no investment knowledge can panic. But people armed with perspective, people armed with a little bit of data,
You want to stay invested.
you actually ask yourself, yeah, actually, I can turn this fear into opportunity.
Yes.
And legend has it that the word in Chinese, the word crisis actually means opportunity.
Really?
Right? The same word.
Wow.
Take it from this banana
Wow, that's
to another
cool.
banana. You can
One
fact
from
check.
one banana to another banana.
You check it in the comments, right?
We're both surprised.
Yeah.
I'm surprised. I just wanted to, talking about comments, I just wanted to look in on chat. So, hello everyone in chat. Hello to VM.
Yeah.
I wanted to ask you guys where we're seeing so many things happening in the markets, right? And we are going to talk about it in the next segment because I want to know what you guys are out there are feeling. How do you guys feel about your portfolios? How do you guys feel about Trump's policies in the markets, the effects on the markets, anything really? I just wanted to hear what you guys have to say. You can just chat with us in the chat box lah. I do want to apologize because I am having the sniffles.
Yes. Not a breakdown because of the markets, but I think that's a very good time to move on to the third and final segment,
Ask away.
which is Ask Away.
Yeah, so this is the segment where we answer real client questions live, and I wanted to focus on this segment today as well because there have been a lot of real client inquiries about our portfolios. You know, the questions are, for example, do we want to do anything? Is Stashaway going to do anything about Trump's tariffs and all this market volatility? And I think these are all very fair and important questions. So what's Stashaway's stance on all of this? Will we be shifting our asset allocations in response or anything like that?
Yeah, so obviously we get a lot of questions when we endure market downturns like this. And the questions range from different investors with different understanding of the market. So to some of our investors, we are their source of market knowledge. We are the source of the market news. So they are getting the information on their Stashaway app, and if they see their portfolio performance go down, they'll ask, hey Stashaway, what's up? They may not be aware of the surrounding context, which is important. I think if you open your Stashaway account every day or once a week in some sort of regular, frequent cadence, and you judge the performance of Stashaway just based on the fact that it's down or if it's up based on your eyeballs on the app,
Just that number.
that's not enough, because you also have to be aware about the markets surrounding how we deliver that performance. For example, when Imran said S&P is down 10%, but our riskiest portfolio is down 4%. If you just look at your portfolio and react to, Stashaway is down 4%, what's going on? Stashaway is not good. I would say compared to the markets, our diversification has paid off because of gold, because of global allocation. So judging just based on down and up, of course that's what we are invested for. But because we're looking at things in the long term and there's some volatility obviously on the downside, you need to understand the context around the markets. So it's not really an issue of us mishandling this money, it's us managing the money in the best way we can given market environments.
Yes.
Okay, so if I boil down a lot of these questions, and there were a lot.
There were a lot of questions.
So many questions.
So many
Okay, sorry. I put the Trump impersonation back in the box. But so many questions. But if you boil it down to 2 questions, what are those questions? The first one is, as a robo-advisor with a systematic investment framework, what is your platform doing about this tariff Trump tantrums, right? The second thing is, should I get out of the market and recover or seek shelter in cash? So, number 1, what's your platform doing? Second one, should I seek shelter in cash? Okay, so to also acknowledge the fact that I understand it's never a positive feeling when you see your portfolio performance go down. You all have short-term goals that you were looking to meet. Down payment on a house, trying to pay for your kids' education. These are all very real-life things and why we have committed to deliver good long-term returns. And for anyone also who is staying invested or looking to put in more money, it takes courage to look at these returns when they're going down.
Oh yeah.
So I acknowledge all of those feelings, but to dispel kind of like any misunderstanding about how our platform or how Stashaway manages your money, I must say this. So the focus of how we choose to invest, or in our words, perform asset allocation, is by looking at economic data, specifically economic data around inflation and growth. So the way we do it is we look at things like GDP or PMI, and all this feeds into our system called ERA. And then that decides which economic regime we're in. Is it an inflationary? Is it in good times? Is it in stagflation? Is it in a recession? And we allocate accordingly. We look to allocate for a multi-year period of time. We don't just go from asset allocation to asset allocation from month to month.
Right. So like for example, if you're talking about the tariffs, and then US market is what is it going to be like? Should we exit? No, we don't think about it in that way.
Exactly. It takes in economic data. What it does not take in is political risk. It doesn't necessarily take into account geopolitical risk. We do other things, like we diversify to cover those risks. But if, let's say, there was, with Ukraine war, there was no special allocation for wartime, no special allocation for Trump woke up on the wrong side of the bed. We allocate according to where the US and world economies are, in the view that we will remain in this position, we remain in this investment for a year, if not more. We're not looking to change every month or every week or respond to things that are not within this model. We respond to economic data, which is historical data, not forward-looking data or predictions or things that are happening live, like this tariff situation. It's not forward-looking. So it's optimized or geared for the long term, meaning that asset prices will reflect the fundamentals. And in the short term, in the medium term, things will fluctuate, right? Today it's worth something, tomorrow it's worth another thing. And very few systems, if any system, can predict what's going to happen. All that you've seen here in the last 2 weeks is reactions. If you have had predictive systems that can be in position before these things happen, I would say it's very rare, or maybe they're acting on information that we're not looking at. So that's the first point. We are looking at historical data. We're not trying to predict the markets. We're not trying to respond to everyday policy making, especially when it comes from the Trump administration, which has very little predictability, very little predictability, or long-term, not long-term, a thought process that has the long-term future ahead of it, right? So news we don't respond to, and all of that. So ultimately, because we are diversified across asset classes, across geographies, we can therefore, in the long term, outperform the S&P, which is it's not our benchmark, but I can say that our portfolios are safer in terms of the risk reward than the S&P, but we cannot escape the market meltdown because we are exposed to the US.
I mean, what are these general investing portfolios invested in? Market assets, right?
Yeah, and a big weightage is affected by how the US performs. But ultimately, because we're diversified, we tend to outperform, right? So I guess you really have to understand what Stashaway is doing with your money. And that's why keeping in touch with what our communications are, right? Our emails, our weekly bars, our CIO insights, shows like this help you go, oh, okay, that's how Stashaway invests. And you don't have this misconception in your head that because of AI, machine learning, systematic investing, we are this magical black box that can foresee everything in the future and therefore avoid a situation like this and only invest the things that go up. So it's really that expectation needs to be realigned. Yeah.
And I think we are quite transparent. Like we are very transparent.
We try to
about
be, yeah.
How ERA
Yeah.
works and what is our methodology.
If you're an investor, you know at any one point in time what ETFs
Yeah.
we have taken to build your portfolio,
Yeah.
right? There's no.
In fact, if you want to, using our flexible portfolios, right, you can actually reconstruct a general investing portfolio by yourself because it's just made of ETFs that are
Yeah.
available to everyone.
So second point, I know I tried to explain that and it took some time, but I thought it was important to emphasize.
yes.
The second thing is, should you exit to cash? Okay, I would only say yes to that question if you're up against a pressing need for money now. So if your investment goals coincided with using that cash today, if that money is enough to meet your obligations, yes, you should cash out. Maybe it is not such a good feeling when it was a certain amount and that has dropped. But if you need the money,
If you need the
you
money.
need the money. That is why you have invested. Maybe if you've invested for 5 years and now you need the money, right? It's not ideal that you need to sell and meet your obligations today. But unless that is the case, you should not take shelter in cash, right? Because
Yeah, and I want to say like we're talking about exiting to cash or relinquishing your investments in a way. For me, volatility like this shouldn't be a reason to abandon your investment plan. You had a plan from the start,
Yeah,
right?
yeah.
I would say so. And that plan is volatility is when the plan matters. That's when the plan should come into effect,
Wow.
right? Like that's why you had a plan in the first place,
that's true.
right?
That's
So
true.
you shouldn't
That's so
abandon-
true.
I don't think you should abandon it.
I'm learning on this podcast. This is amazing.
So please,
That's so true. That's so true. Because any kind of like any garden variety volatility, people will just go, okay, I don't feel it.
Yeah.
But when you are feeling it the most, that's when you need to remind yourself of
You
why
have
you
a
set
plan.
out to invest.
you have an asset allocation, you have a strategy.
Well said. I think you can do this show alone. I think I
No,
really
no, no.
I think you're ready.
I need you.
Ah, well, okay.
I need someone to.
To banter with. Another point I wanted to make is that apart from you needing the money today, getting into cash, is abandoning your plan. Well said, but also it is close to like the worst thing you can do, especially now because you are essentially panic selling, and like we said, all throughout today's conversation, without context, without data, it's just the wrong thing to do, right? So I think you should seriously reconsider if you are thinking about cash, because that would essentially be panic selling. And again, just to re-emphasize, repeat points that we keep bringing up, if you look at the long-term enough horizon, this will be one of those blips that you see along the way with speedy recoveries, and then markets will be in a better place. Right now, because we are in this maelstrom, right? We are in this storm. It's very hard to see a way out because it's not a normal trade negotiation. This is a rewiring of global trade, which has taken decades. And Trump thinks that with one strategy, he can upend everything. Like, obviously he can't. There will be a normalization at some point. We don't know. I don't know. But when that normalization happens, the markets will then adjust and reflect that new value. So there's some turbulence,
Oh yeah.
but we'll get through it. And like we said earlier in the show, President Trump and his advisors' strategy is to ultimately raise revenue for the US to do other market-friendly things.
Yeah.
The Trump presidency vowed to bring in tax cuts and deregulation, and because of the deficits, they didn't want to just say, let's just stimulate the economy.
Yeah.
They wanted to do it through this way.
Actually, where you can read more about what our CIO thinks about the situation as well in more detail, exactly what Ken is saying, where the administration is looking at short-term pain, long-term gain. I'm
No
sure
pain, no gain.
Some of us.
I read the piece, good piece.
Yeah. So, in fact, when you can see right now what Trump is posting on like his Truth Social, it's about it's about tax cuts and deregulations. So he's
He's moved
bringing
on
in
to
that
the next
narrative
thing.
now. Yeah. I think they just signed a bill or something. But it's okay. We don't have to get into the news of it.
That's why we have a show next month.
I just want to say, he calls it a big, beautiful bill.
Oh, so no details, but it's
No
big and
details, but it's big, it's beautiful.
Okay.
Lots
all
of
right.
tax cuts
We'll-
and
we'll-
deregulation.
We'll
So-
take your word for it.
So those will be good for the markets. I don't know. It doesn't matter. The point is the long term, what we are seeing here, right? Eventually, markets will normalize. So, thank you. I think that's about it. Ken, if you had any other thing, anything else? Yes, thank you everyone for watching. It's been a rather long show, but I think it's very important that we address most of this. So thank you everyone for watching, and we'll see you next month because it's now a monthly show. So, but it will happen on a Monday at 6 p.m. and we'll let you know beforehand. So thank you everyone.
Bye bye.
Bye.